Hello, everyone, and welcome back to this week's episode of the Rose and Rubini podcast, Making Sense of This World. My name is Manas Chavla, and as always, I'm joined by Brunella Rosa, CEO and Head of Research. It's been a very turbulent week in political and economic markets, but there's lots of murmurs of a tech bubble. It's every time a bubble comes up, it's something that sparks a lot of anxiety, particularly within investors. And this one's, it's coming off the heels of what we saw happen with Twitter. Elon Musk has bought this, big company for $44 billion, and effectively fired half of the company's workforce. On the other hand, you look at Meta, the other big player, Zuckerberg sent one email, fired about 11,000 employees. FTX, one of the major crypto exchanges, effectively is also falling down. I mean, it seems like in all directions, everything's crumbling apart. Is this your assessment, Brunello? Is there really a tech bubble? Is everything coming to an end?
Yeah, so all these events that you mentioned are there, and there are others. There are the intentions also by Amazon to fire a few thousand people, potentially 10,000 and so on. And somebody got infuriated by the fact that the founder, Jeff Bezos, says, I'm going to give away most of my wealth when I die and so on. And people say, well, before doing that, just keep your employees on in difficult circumstances and so on. So just to give you another example, but clearly catching the headlines for Twitter, where Meta, where the FTX effectively collapsed with Binance not coming to the rescue as somebody might have expected. More in general, Nasdaq has severely underperformed the general indices, S&P, and even the Dow Jones did better than the S&P. Nasdaq is down almost 30% this year, while the S&P is effectively half of it, 15, and Dow Jones half of the S&P 7. So effectively, it's what it seems to be the revenge of the old economy. So the question is, was there a bubble in tech, and has it collapsed, burst? Our assessment is that this is not the case for a series of reasons. So first of all, it's not the first time that the tech sector goes through a similar episode. Already in 2000, we had the explosion, so to speak, the bursting, if you want, of the dot-com bubble. And after that, technology remained one of the key drivers of the economy in the US and elsewhere. Secondly, the tech sector had expanded quite dramatically during the pandemic, because clearly we were all stuck at home. We all had to use the instrument that we are using today to record this podcast and all other instruments for delivery, for communication, to work, to play, to watch TVs, movies, whatever not, right? So everything was about tech and online and remote, all words that we have heard hundreds of times during the pandemic. So that was kind of an acceleration, a bit bubbly if you want. And it was meant to go down as soon as there was a reopening of the economy. Third, we got a series of innovation in the tech space that are coming online and will further come online in coming years, including from our beloved central banks, which are thinking about entering the cyberspace with CBDCs. We discussed this about in other occasions. So there's lots of technology that will be used in the future. It's not surprising there's a reassessment of current valuations, but there's a bright future for technology going forward, especially in terms of the digital infrastructure that will need to be built for this technology to work and operate. So yes, it's not nice. If you have invested heavily in technology, clearly you're losing money, more than if you had invested in more diversified manners. Maybe there was a mini bubble, maybe it's bursting, but this is not the end of the tech sector for sure.
Interesting. And he spoke about quite a few different things there. One of the things I sort of got from that was effectively we were already on a kind of, a course for an adjustment. We'd seen these tech companies be propped up while all sort of other financial markets were crashing during the pandemic, because the very intrinsic need in providing these basic services. But it's also not the first time it's happened. I think it's, all the sort of hysteria that we associate with the dot-com crash of 2000 that makes us think of this as something that can happen anytime and will have consequences as disastrous as that. But I think there's also something to be said about the application of big tech beyond the bounds of what we already know. We think of big tech as Meta and Google and Amazon. And effectively, the social media companies, but there's really cool new applications, CBDCs being one of them that you've talked about before, but plenty of others. Could you speak to a bit of those?
Yeah, I mean, the key point is that there's always a transition. There was Web 1.0, which was effectively companies or institutions showing something on a platform that people can look at. It was kind of one direction. Then Web 2.0, 2.0 emerged, whereby was the read write as is written. So as it's been called, so that you not only read, but you can only write. We can also write. And that's effectively all the things that we have been doing in the last, say, 10, 15 years, blogs, social media of all sorts, being the Twitters, being the Facebooks, being the LinkedIn. We said, oh, I have something to say, something to showcase. Let me put on the website. Let me comment on other people, the kind of inputs and so on and so forth. And then we are going into Web 3.0, which is already somehow among us. And this is about ownership. So it's not just that you can read and you can write, but then you own part of the cyberspace. And that's clearly an innovation, because then you start owning a digital asset effectively. The easiest form will, of course, be the currency, in the sense that you have a paper currency, you need to transform this into some form of digital currency, hence the famous CBDC. Once you have CBDCs or other forms of digital payment systems, such as stable coins, then you have a digital coin, if you want, that you can use to buy digital assets in a digital universe, or metaverse, the way it's called. And then you can do lots of things. And to do these lots of things, you will need exactly that kind of digital payment system that you need. So this transition from Web.1, 2, and then 3 guarantees that tech will remain at the center of attention in coming decades.
Fascinating. And what that also means is we have to sort of reconceptualize how we think of, tech. It's no longer simply private companies with lots of money. It's entirely different ecosystems. It's almost a sense of digital sovereignty. There's an entire different playing field. With a tech company doesn't provide a single service, but a host of them, including currencies. So it really is sort of a whole, reshape of the way we we're thinking about it. But it goes back to the big question. I mean, all these things still happened. Facebook still fired these workers. Amazon is still doing what it's doing. The Nasdaq was still down, substantially. Same for Twitter and FTX. I mean, there needs to be a way to explain some of these things. I think you put forward two different theories. One of them from Minsky. Tell me more about that one, and how that would sort of interpret this.
Yeah, so what Minsky said is that over time you develop fragility in the system. Somehow it's the periods of stability that creates their own instability in the future, the so-called endogenous risk develops. And when is it that this materializes and becomes visible? Is when there's a sort of shock by which positions that were considered to be sustainable until a few periods before, then they become unsustainable. And the typical shock clearly is the increase in interest rates. That's a typical example. Hence, what we see is that central banks are increasing interest rates to control for inflation. And guess what? There is creating financial instability episodes. We discussed this in previous column when we talked about the conflict within monetary policy between price stability and financial stability. This is the perfect example, in the sense that you control for inflation, but you risk creating financial instability hypothesis. So I think this is one of the two theories that I think helps explain what's going on.
Sure, sure. And a second sort of related but very different theory as well is Schumpeter's idea of creative destruction. You know, it caught all the headlines when it came out and something we refer back to every time there's a crisis. How would that theory sort of interpret the current tech context?
Yeah, I mean, there are several theories that can be thought about. I quoted two. Another one is Knut Wicksell, a kind of unknown Swedish economist that actually introduced an important concept that is the one of neutral interest rate that has been used so many times and now has been refined and so on. But again, Schumpeter is one of those that every time there's a crisis, it needs to be considered. He calls this the creative destruction of capitalism. You shouldn't be saving failing companies. If they are failing, there must be a reason. Clearly, there might be mismanagement, whatever not. But most of the time, it means that they were not apt for the type of environment that is being in place or will be in place. And only if you get rid of these zombies effectively, then you free the resources that can be allocated in new companies. This is the creative part, in new companies, in new ventures that are more sustainable and more in line with the environment that is about to emerge after the crisis. So there's effectively a combination of these two theories. Interest rates go up, financial stability hypothesis is realized, so financial stability occurs. There's a collapse in valuation. There's the creative destruction that Schumpeter talks about. But again, the world is not over. History is not finished. There will be a period of reconstruction under a new paradigm, under new circumstances. Resources need to be freed from the zombie companies to the new companies, and it will happen, including in the tech sector. So the tech sector will probably emerge from this crisis stronger than it used to be. When the dot-com bubble burst, the vast majority of companies that were created at the time, of course, went under. But also, even if only few survived, the market capitalization became gigantic. Just think about Amazon. They can, in fact, be the champions of the future. They had been in the past. And so some companies that may survive this crisis and so show that they're up to for the new environment, they may become the champion of the future. And so I expect this to happen again. Again, it's not nice to be invested in tech in this period. You're definitely recording losses. You might record even more losses for some time. But eventually, technology is what's driving the world in this period and will continue to do so in coming years.
Sure. And in this process of creative destruction, there's, you know, financial and economic creative destruction, but also plays a very important social role. It kind of reemphasizes to society, you know, what kinds of technology that we want most. You know, effectively in the low interest rate environment of post 2007-8, there's been, you know, so much private capital floating around to fund every single idea that comes out of Silicon Valley, whether that's, you know, salad delivery on the gig economy, on the blockchain, powered through cryptocurrency. It's, you know,
Absolutely.
it's one ad after another. And so effectively, you know, this might, in the long run, be seen as a good thing, where, you know, socially, we've sort of reprioritized in a stressful financial environment exactly what we want our capital to be going to. Certainly something, again, you know, we'll be watching for a while, especially in the long term, especially as things kick off, you know, in the UK with a stressful sort of macroeconomic environment, but also geopolitically in the world. But as always, Brunel, thank you so much for your advice and insight.
Thank you very much, and until next time.